Reservoir engineer with over 15 years of experience, holding bachelor's and master's degree from the Faculty of Petroleum and Mining Engineering at Swiss University. He has contributed to key onshore and offshore projects in Egypt with national and international oil companies. He has authored and co-authored over 8 technical papers published by the Society of Petroleum Engineers. In parallel with his industry work, he lectures in reservoir and petroleum engineering at the Arab Academy for Science, Technology and Maritime Transport, and Alexandria University, supporting the Petroleum Geology Master's Program. Please let him a warm welcome.
Thank you. I'm very glad to be here in the webinar with MegaPlus. I'm Engineer 𝗥𝗲𝘀𝗶𝗵𝗁, Reservoir Development and Reservoir Evaluation. And today we are going to present the Oil and Gas Reserves Evaluation and Estimation, or Resources and Reserves Evaluation and Estimation. But first, we don't want to forget our responsibility and sustainable development goals and our responsibility for the climate and nature and people. Do not forget, it's very important. And before we start with the webinar, I need to start with 2 questions. How the oil and gas business in E&P companies work, exploration and production company, and what are the main rules of reservoir engineers? Like any business, first we have to evaluate our reserves and our resources in terms of money, and see the cost to get this money, the capital cost and the cost of the operation, and then it must be profitable at the end of the project. So how does this business work? And what are the main rules of reservoir engineers? Here, our rule is to evaluate these reserves, make the production forecast that depend on it. It will be a plan, and we have to make a final investment decision about the project and to be profitable. So this is how the business works. But at the end, it must be economical, and it must be evaluated. So our agenda today, we will start with 3 whys. Again, 3 questions: the reserves evaluation scope, resource management system, the PRMS system, the SEC, uncertainties and chance of success, reserve estimation method, and field development plan. So we will start. We have in this webinar 2 sections. The first section, it is about the resources and reserves evaluation. So the first question: will oil and gas resources and reserves decrease or increase in the future? Before I go to the industry, I thought that the reserves and resources must be decreased in the during lifetime. But after I worked in the reservoir engineering and the industry, I found that no, it's not sure that the resources and reserves must decrease. Maybe we have new exploration, maybe we have new resources to be added, like tar sands or unconventional resources. So the technology and the commerciality and the oil and gas price is the main player in that game. So it will increase or decrease, we don't know. Maybe increase, maybe decrease. It depends on the technology. It depends on the prices and the commerciality of these resources. This portfolio that done by British Petroleum published, you can see it in the website, see that the reserves and resources is increasing, and the dotted line is the prices. So something like tar sands, something like unconventional heavy oil join the resources, so it's commercial. So that's why we can say that no, it could increase in the future. So the second question, the differences between reserves and resources, and this is the most important question, or the most important difference to know. When we say regardless commercial, we are talking about resource. When we say commercial, we are talking about reserves. When we include discovered but sub-commercial or undiscovered, so it's resources, not discovered or discovered and not commercial until now. If it's commercial, okay, it's agreed and commercial and disclosed, so it's a reserve. And of course, if we are dealing with undiscovery, so we have high uncertainty in it. But if we are dealing with reserves that already discovered and evaluated, so we have low uncertainty about it. And for the reporting framework, we often reporting resources in the exploration and planning reported. But in reserves, we used to report reserves always in the financial reporting, development planning, and reserves booking, and we will know what the meaning of reserve booking in the next slides. The third why we have to evaluate the oil and gas reserves and resources. Why? First, for investment and financial reporting, for field development planning, for project economics and risk assessment, for our risk management, regulatory and legal compliance, and this is belongs to the government and national companies that they must have reports and assess their reserves so they can have a strategy. 5, strategic planning and portfolio management. So companies like IOC or international companies must have their portfolio so they can evaluate their companies and know the value of the company. And the last thing, the operational monitoring. For reserves, I have to make a forecast, and I have to monitor this forecast in the actual data. So I have to make the reserves evaluation and monitor across the production, so I can see that I have full understanding of my reservoir and I have credibility in my evaluation. So what is the reserves evaluation scope? What is the scope of reserves evaluation? We all know, I think, the IOC, the international companies as BP, ExxonMobil, all of this. So they are concerned with the reserves evaluation, and we will see why. Second, the national companies and the government. National company and government must have to know the reserves in order to make the strategy and the export and the import of the oil and gas, what they have, and the source of energy, and to know what can they do in the future, and etc. And the banks and independent evaluation firms. For the banks, sometimes I have to make something called reserve secured loan. So companies or government could get a loan with against the reserves, and they have to evaluate. And the independent evaluation firms have the rule on this evaluation as a third party. So here, it starts with a conflict. The conflict could be in the same team. It could be between the national and international oil company in the profit share agreement contracts. That there's someone say that it's about, as an example, 2 million stock tank barrels reserves, and another one says it's 10. Maybe he's optimistic. So there's a conflict. So to deal with this conflict, the resource management system starts to publish something like constitution or guidelines that we have to deal with. So there will be no conflict. It will be a management system that will say that we have approved reserves, we have probable reserves. It's like a constitution or guideline. So after that, the stakeholders they will be okay after this constitution, but with level of confidence. So we will go all agree that if we have an oil in place or reserves like 2 and 10, we are confident that they are 2. But no one is we have less stakeholder are confident about they are 10. So it's about level of confidence. That's why we make uncertainty and chance of success assessment in order to make the satisfaction in the between the conflict team or conflict companies. So we have here reserves with different confidence, and make assessment for uncertainty and chance of success that we will see in the later slide. What is chance of success and what is the risked and de-risked reserves. So we have here a game, I think, between the independent evaluation firm and resource management system. What are both? First, I will start with the independent evaluation firm. They play a crucial role in oil and gas industry by providing objective third-party assessment of reserves, resource, and assets. They offer expertise in data analysis, modeling, forecasting, helping company make informed decisions regarding investment, development, and compliance. So their role is as a third party to certify or approve the reserves of the company as a third party. And reserves booking, which what mean by reserves booking? It is a process by which they are adding these reserves to the company balance sheet. So here an example of companies that work as an independent evaluation firms has license as D&M, CG&A, M&A. All of these companies works as independent evaluation firms. So the second, we say that we have independent evaluation firm, and the second thing will be resource management system. It's about the constitution or the guideline. So we have many resource management system, but we have a very popular one that all the world was working with it. I think it's called the PRMS, the Petroleum Resource Management System. And they classify and categorize the reserves as P, as a reserves, or contingent resources C, or prospective resources with abbreviation U. And we will see in the later slides the differences between them. The UN also has a classification system according to the economic viability, the feasibility of extraction, and geological knowledge, and abbreviated by E and F and G. And also they will classify according to the confidence. Maybe if I say 1E, so it's very high confident. When I see 3E, so it's lower confident. Same as F and G. We have Russian classification system, which categorize the reserves as A, B, and C, 1 and C2. They are all management system, but we are concerned with the oil and gas business that dealing with the PRMS and something called SEC that we will see later. What is PRMS? Briefly, that we have to know that in 1930, there were an early guidance focused on proved reserves, but in 1987, Society of Petroleum Engineer and the Society of Petroleum Evaluation Engineer, the SPEE, published a definition of all reserves categories. And in the same year, WPC, which was the World Petroleum Council or World Petroleum Congress, independently published a reserves definition that were similar to the SPE and SPEE. In 1997, two organizations are jointly and make a definition of reserves that could be used as worldwide. In 2000, the American Association of Petroleum Geology, the APG, the SPE, and the WPC jointly make the classification and make the guidelines in 2001. In 2007, the SEG joined and supports the society. In 2011, the SEG joined officially and published a guideline application called PRMS, and we are working with it right now. And I think the last update was in 2018. So here is the Petroleum Resource Management System report or the guideline. So it's published. And I think anyone can get it, and or I can through LinkedIn I can send it. It's published, so you can see the guidelines of the reserves and classification. But here in the webinar we will summarize the important items that were mentioned in the PRMS definition. I'm sorry, I have 1 second. I will come back, I think. Okay, I'm back because there are some technical issues. Okay, for the PRMS definition, we have some terminology or definition. We have to, it's very important to mention it. And it's like, as I said, a constitution. So this terminology is not just a terminology. This terminology is or definition. All the company worldwide and all the government must respect this. And maybe the strategy of the or the forecast or the reserves is according to those definitions. So they are very important. The definition, as an example, we will find more than 50 or 60 definition. I summarize it into, or the important is 9 or 10. So when we talk about resource, as we said, recoverable and unrecoverable, discovered and undiscovered, conventional or unconventional. We are talking reserves. It must be discovered, recoverable, commercial, and remaining. When we talk about the initial petroleum initially in place, it is the hydrocarbon that exists originally in nature, naturally according to the accumulation in the reservoir. But I can't extract it 100%, of course. There is something called recovery factor. The recovery factor that if I have the hydrocarbon in our reservoir, I can extract maybe 10 or 20%. So this, the original oil in place multiplied by the recovery factor, we can estimate the reserves. And another terminology called estimated ultimate recovery. And we always use in something called decline curve analysis that we will see later. It is will be equal to the proved remaining reserves, plus the produced. For the technical recoverable resources, TRR, when you read something like TRR, is according to the PRMS definition, we are talking about the reserves regardless the commercial consideration. Okay, we are talking about the resources regarding the commercial consideration. The TRR is according to the technical or the technology or in the industry can support extraction of those resources. For CIO, when you read CIO, we mean consumed in operations. You know that we are dealing with the production, but we have to consume some of this production as a fuel for the platform or the as a fuel for gas turbine that operate the field. So we can the final reserves. It will be the sales gas or the sales oil that we subtract the production from the consumed. The net revenue of interest, it belongs to the companies that are dealing with government, with royalty contracts or profit share agreement contract, that maybe if I am an international company dealing with a government and under a profit share agreement contract, I can have the 35% of the production in addition to the cost recovery. So in that, I have to, as an international company, to get the net revenue of interest that after the royalty and after the agreement. And here, the final investment decision, the last definition that I will mention, is very important. This how the company can announce their final investment decision. And according, as an example, to the PRMS, the project approval stage, when the participating companies have firmly agreed. So if the participating companies firmly agreed and the project required a capital funding, according to the PRMS, the company can announce that we have a final investment decision. And I mentioned this terminology because this terminology can differentiate between PRMS and another management system like SEC. SEC definition, it must have a capital funding. Here, it doesn't require a capital funding. So, but if the company is working or approved by the SEC, so when they say that we have a final investment decision, so they have the fund. But according to PRMS, only the company agreed or the participating companies are agreed. So according to that, you will find the company strategy or the company announcement differ from one another. Before we go to the PRMS classification and categorization, this simple seismic can differentiate between reserves and contingent resources and the prospect. If we have something like here, here's the seismic section. If we have an oil and gas volume right here, and the volume is commercial to be extracted, so we are calling reserves. But what if we have the volume as C is lower than the volume of the reserves? It's much low that I can't produce it commercially or economic. It will not going to be economic. So it will be considered as contingent resources. Maybe the technology is not supporting to produce it. Maybe the oil and gas pricing not supporting this production right now. So we will wait. Maybe I can produce it in the future. And here, if I have this volume not discovered, not intervened by any exploratory well, But I have the geologic setting, I have the play, I have the all of the clues that I have hydrocarbon right here, but not interviewed or discovered, so we call it prospect. So the PRMS make this pretty classification and categorization of reserves, and they make, if you see this chart, if I say that the vertical axis, you will see the classification. When we say, according to PRMS, the classification, we will see it's a prospect or contingent resources or reserves. When I say categorization, so I'm dealing with the uncertainty. I'm dealing with the level of confidence, whether it's 1P or 2P or 3P. And what are the differences between them? We will see. First, reserves. As mentioned, reserves must be discovered, must be recoverable, must be commercial, and must be remaining, that I already developed and I have remaining. And as I mentioned, that the reserves, it will be the sales quantity. So if I have the production or the production forecast, I have to subtract the CIO. That's why we have to mention the terminologies and definitions. For the contingent resources, it's not commercial. Currently considered as not to be commercial. Currently, now I cannot, the technology or the oil and gas price not supporting, but in the future it can support and it could be turned to reserves. For the prospective resources, it's undiscovered accumulation. Here about the classification. When we say categorization, so I'm dealing with the level of confidence. If I say that reserves is 1P, it means proved 90% confident. 2P, proved plus probable 50% confidence. 3P, proved probable and possible, which is 10% of confidence. Same as the contingent resources 1C, 2C, and 3C. Same as the prospective resources 1U, 2U, and 3U. And always the decision making for development, in sometimes it could be the 1P, and in sometimes it could be the 2P, but almost and always we use the P50 or 2P, so we can take the investment decision according to the reserves that we have or the prospect that we have, so we can deal to make an exploratory well or development well according to the P50. Another important thing that mentioned in the PRMS called incremental projects. If you hear or read about a terminology called incremental project, they mean that if I have a project that already produced and I need to enhance or increase the production by workover, by stimulation, by if it's a gas field, by compression station, or adding infill well, or make enhanced oil recovery like polymer injection and drilling a new well or something like that, and the material of the polymer, we call it incremental project. So it will be the forecast will be also incremental. The last thing important in the PRMS, you will find the unconventional resources like the shale gas, if you know, or shale oil. But we will not go deep in the unconventional, but the differences between the conventional and unconventional briefly. If we say that it's the permeability of reservoir is more than 0.1, and in some references 0.01, but for me, I'm confident about 0.1 millidarcy. So if it is more than that, so we are dealing with conventional. If it's less than 0.1, we are dealing with unconventional. For trapping mechanism, the conventional is we must have a trap. We must have a structure like fault or dome or stratigraphic trap. But in unconventional, it's not. We can deal with not obvious structure or stratigraphic trap because it's trapped in the pores without any structure configuration. For the hydrodynamic interaction, you know that the gas and the oil that outside the water, in the conventional resources, the hydrodynamic interaction is present, but for the unconventional resources, no hydrodynamic interaction can significantly, or the resources not significantly affected by the hydrodynamic influences. So there's a difference between the unconventional resources and conventional resources. So finally, we have to say about the reserves and resources, a very important thing, which is called project maturity. What is the project maturity? If we are dealing with reserves, if it is on the, or if we have reserves that as commercial and discovered and all of that, and we are working to justify, make a justification report for the shareholders or the board to approve it, it's in the justification phase. So it's a development justified. This is the maturity of the reserves right now. But when we have an approval from the stakeholders or from the shareholders or the board, so it will be developed and approved. When we drill a well and start to production, so it will be a high level of maturity, which is on production. Same as in the contingent resource. If the development or the this resources is far away from commerciality or far away from the technically or the technology to be extracted, so it's not viable. If it is supported technically and supported through technology, but not commercial, but also it's far from the oil prices right now to be produced, so it will be on hold. Pending when, as an example, if the oil prices it will be $50, when it will be 60, it will be commercial. So I'm saying that this contingent resource is development pending on the price, as an example. For the prospective resources, it's another game or another terminologies. We are dealing with something called play and lead and prospect. As we mentioned before, that it's undiscovered, like here. So what are the difference between play and lead and prospect? And I can give you an example, so you can say that see how things work. If I have here a geologic area, only a geologic area that I have, or geologic framework that I can expect that I have a potential here, so we can say it as a play. But if I have only an anomaly from seismic that can put this area in more confidence or more mature to be drilled or to be studied, so we can call it lead. For the prospect, we have a fully evaluation by analogy, and if I have right here as an example, if I have here a drilling well that already developed and there is an extension of a channel or an upside of a upthrown of a fault, so I have all the clues, so it will be a prospect. So it's like a funnel. It's if I have first I will start with the play, and I will filter to lead, and I will filter it to prospect. Like in any as an example, real estate, if I'm dealing with people to make my sales and marketing, I'm dealing with the leads. When someone say that I'm interested in your what you are selling, so he will become a prospect for me. That's how things work. And this is the this key workflow that published by 𝗥𝗲𝘀𝗲𝗄. You can find it at this website. See, I can summarize the play evaluation here, that we have a basin configuration and the tectonics, so they can make a basin evaluation right here through the structure, and then they study the source rock and where is the source rock, and assess the migration path. So right here, maybe the source will be in the Triassic and the or Cretaceous, and the reservoir in the Pliocene or Miocene. So I have a full evaluation of the play in that area, and then see the trap distribution, and finally identify the play. So here, how they can evaluate a play without any anomaly. If I have anomaly from seismic, so we can call it a lead. So after that, we have to make a chance of success. And chance of success, many variables or many parameters for references, but this is the most popular one, that in the chance of success, I have the three main parameters about the play: the reservoir, the charge, and the source, and the trap. And in each parameter, I have to see about the level of confidence of the presence and the effectiveness of each. Like example, I have here the presence of shale. I know that we have a seal rock right here, like shale. I have the presence of it. and it maybe extends. So maybe I can put a 70%. And shale, of course, it will seal. So the effectiveness of the shale to seal is maybe 100% or 80% about how pessimistic or optimistic you are. So I can get a percentage for each parameter and multiply all, so I can get the chance of success. As an example, 15%. So if I multiply all of this, it will be, I will have 15%. So this 15% will multiply by the evaluated reserves, as an example, P50, and we call it unrisked reserves. And we'll see in the upcoming slide. So now we finished the PRMS management system and the guidelines and how they categorize, and we will start the in the first section. The last thing is the SEC, and what is SEC is very important for us to know. It is stands for Security and Exchange Commission, and U.S. federal agency responsible for setting a standard for how company must report reserves, financial data to ensure transparency and investor confidence. And the difference here between the PRMS and the SEC, that SEC is an agency or an entity that responsible for disclosure of the reserves in the US. So if you are a company that are dealing with a US market or dealing with US stock market, maybe from US or outside US and dealing in the stock market in US, so you have to make something called disclosure of the reserves to announce your reserves in the stock market. So you have to evaluate or make evaluation for your company for transparency and the share or the stock price. So the SEC reserves closure depend on the it must report approved reserves, or you will see in the upcoming slide the report that for proved reserves. They also dealing with proven and probable reserves, but in the disclosure they put the proved reserves, developed and undeveloped. The estimation, you will see in the upcoming slide that we have two things called deterministic and probabilistic estimation method. They are dealing with deterministic method. In the average pricing, they are dealing that that the reserves must be evaluated in US dollars. So this price could it calculated depend on the 12-month average price the last year. They consider the reliable technology. What if there is another or new technology that make an edit or modification in the reserves? So now and we will see why I'm saying now, because before that reliable technology was not included in the SEC. So if I want to make an update or modify or edit in the reserves, depending on the new technology, now they can permit it. And finally, the rules of US companies that, as I mentioned, that if company dealing with the US stocks market, so I have to make a disclose. So there is a form called a 10K form. The 10K form, all the companies that dealing with US must have this annual report form. Also, not all the companies dealing with SEC, so if they are not working in the US or dealing with the US stock market and can work with the PRMS, like I think Saudi Arabia and United Arab Emirates, Kuwait, so all of them, they are dealing with the PRMS standards. So briefly, the history that SEC, that it was found in 1934 until 1978, API and SPE was considered to make these guidelines. In 2008, they made something very important for the SEC called modernization. What is the modernization of the SEC that is approved in 2009, affected from the 1st of 2010? That the SEC, to make the disclosure for the reserves, there is a lot of aspects, like first the disclosure. Pre-2009 they were dealt with 1P, and after 2009 they are dealt with 1P, 2P, and 3P. For the pricing, they were depend on the single day year end. They see that or the look for the price at the 31st of December as an example, the last day, and put this price to evaluate the reserves. And this is not accurate and not, I think, support transparency, because it can, we can adjust this price. But now it's a 12 months average price. As I mentioned, reliable technology. Before 2009, it was restricted. I cannot edit my reserves according to the technology. Now it's allowed for the non-traditional resources as conventional, unconventional. Pre-2009, it was restricted. Now it's allowed. So here, how the SEC system after 2009, they are now classified as approved reserve, proved developed and undeveloped, probable reserves, and possible reserves. And here the annual report form as an example, ExxonMobil that published on the ExxonMobil, and they have to publish it, of course. You will see that we have the 10K. If you see that here, we have to form 10K. We have developed, proved developed, and proved undeveloped for 22 and 23, 24. This is how the companies must announce or disclose their reserves. And how SEC can audit something like that. Here's an example, and this comments were from the SEC to companies, 110 companies, to disclose. This is how it works, to disclose the reserves. And that was published in the paper in SPE. You can find it with this number. It's like here they are asking the company to describe the procedures that they are undertaking to prepare their reserves estimate. And please describe for the greater detail for the nature and content of the information presented of the board of directors. So when I'm, as a company, sent to the SEC, my reserves, I have some comments, I have to commit with it and reply. This is how it works. So briefly, until now, we finalized the evaluation and the PRMS and the SEC, and see how we can classify the reserves according to it. We can approve it, and we can make a reserve secure loan or make final investment decision, and can get the cost of the asset and the operation cost, so we can make a field development plan. This is how we can evaluate officially our reserves. So how we can estimate reserves, how we can calculate the reserves. For the reserves estimation method, we have 5 methods: that volumetric calculation, analogy, we can use material balance, decline curve analysis, reservoir simulation model. And we have to mention that each one must have a full course or many hours to be clear. So I'm trying to summarize or give an idea about each method of reserve estimation. And we can say that we have 4 different approaches. The volumetric calculation and analogy is an approach. Material balance is another different approach. Decline curve analysis and reservoir simulation. All 4 different approaches, they are very different. So we're dealing with these 4, we can have the less uncertainty if we can confirm by all of these methods. We will start with the, before we start with the volumetrics, it's when and how I can use each method. If I'm in the exploration phase, so I don't have any method to evaluate the reserves except the volumetric method, and we will see the analogy. In the early production phase, the preferable is material balance equation supported by the volumetric method, and decline curve analysis is not preferable in the start of the production, but it's preferable in the, if I have a mature field that I have 30% production, and with support with material balance. And of course, we will not going to forget the volumetric method. And if I have dealing with a complex reservoir structure and the petroleum system, the reservoir simulation is the will be the best solution in that time. So we will start with the volumetric method, and the volumetric method we will see what is also the difference between the probabilistic and deterministic method. I think we all know this equation, that the original oil in place or original gas in place, that we must multiply it by recovery factor to get the reserves. It will be equal to the GRV multiplied by N over G phi multiplied by 1 minus water saturation over the formation volume factor. And for important me to know all of these terminologies. When we say or when we read the GRV, we are now dealing with the gross rock volume, which is equal to the area multiplied by the H. When we say that we have NRV, so it's a net rock volume. When we say NPV, we are dealing with net pore volume that we multiplied with the porosity. When we say hydrocarbon pore volume, HCPV, that we multiplied by the saturation of hydrocarbon. And finally, we will divide it by the formation volume factor, and we'll see what is formation volume factor. This is the volumetric method, and this is the volumetric equation. Briefly, or I will go through how to calculate each thing. So when we're dealing with the gross rock volume calculation, we have a classical method that is classic in the classical fundamental reservoir engineering books. We have geometric approach, area thickness method, and area depth curve. For the petrophysical analysis, we have to get, as mentioned in the equation, the net to gross volume and porosity, or the net to gross ratio, sorry, and the porosity and water saturation. And finally, the formation volume factor that can be estimated from PVT analysis or by analogy. And we will start with the gross rock volume. The gross rock volume, it is the total volume for rock contained in the trap between the top and the base and the reservoir, and we have to respect the oil-water contact or gas-water contact. So when we are dealing with gross rock volume, we are dealing the greatest uncertainty that I have to be sure about gas rock volume or make the uncertainty according to it, because it's a huge number in the function or the equation. The classical method that we know that we have pyramid method or trapezoidal method to calculate the volume in each interval. And here's the example that we can say we can see how it could be worked. If I have here a dome or something like this structure, and here is the contour line, and I'm looking for it from the upside. So as a plan view, if I have here this area A1, A0, and A1 is like here. So I have this interval is 5. So if I respect the trapezoidal method, so it will be 5/2, like here 5. This is the H is 5 and over 2. This trapezoidal method, AN plus 1. So if I have this area A0, it will be 450, and this area is about 375. So I have the volume of 2063. I will calculate for each interval like that and make a summation, so I can get the gross rock volume. And if I multiply by the porosity and 1 minus water saturation and formation volume factor, I can get the original oil in place. So how it works, the classical method. Another approach that was published in 2013, it's a little bit or more accurate than the first one. This is same as the trapezoidal and spherical and the pyramid method, but here we are dealing with something called the gross trap volume, the gross trap volume, and the waste rock volume, which it will be here. So I will calculate the gross rock volume according to the shape of the structure that I have. Maybe it will be a cone, or maybe it's like a trapezoid or something, and subtract the waste rock volume. So the gross rock volume will be the subtraction between them. Another approach, which called the area thickness multiply the geometric factor, that I can get this gross rock volume and multiplied by the geometric factor. What is geometric factor? When I suppose that I have as an example, this green one, this interval, I assume that it's a flat, but in the nature, it's not flat. And the nature, it could be dome, it could be faulted reservoir, it could be pinched out. So I have to multiply this area by a geometric factor. It could be in the dome, it's something like standard 0.8. If a faulted reservoir, it would be 0.7. In the pinch out, it could be from 0.4 and 0.7. And all of this method is very quick, but not accurate, as this method, the final method, is called the calculation area depth method. In this method, we are dealing with area versus depth. As an example here, if I at the surface, we have here area equals 0, like here, and I'm now drawing the top. And if I go down here, as an example, the area will be 400, something like that. And if I go down, the area will be, as an example, 1,200. So I have to draw this, which is the y-axis is the depth and the x-axis is the area. So obviously this rectangle will be the volume area multiplied by the depth. So I will draw something like that for the top and the base, and the volume will be the difference between them. So I can get easily and this is the most accurate one, and we use it, and we can get this from the seismic data interpretation structure map. So we can get the top and the base, and if we can interpret the base like many fields, we can have uncertainty. So we can put the top and constant interval like 30 or 40 feet like that, or 20 to 100 feet anyway. So we have a top and the base, and the difference between them will be the volume. This is about the gross volume estimation methods. For the petrophysical analysis, we mentioned that we have net to gross ratio and porosity and water saturation. For the net to gross ratio, when we say a net to gross ratio, we have to deal with the net pay, because in the volumetric, of course, we will deal with the net pay. What the meaning of the net pay? If I have this interval, not all interval is producing. Here is an example. We have low porosity, low permeability interval, so it's non-pay. Maybe it's high porosity and high permeability with high water saturation, so it will be non-pay. But as an example here, we have high porosity, high permeability, high oil saturation, so it will be net pay. Our rule in the petrophysical analysis is to know the percentage of the interval that we're going to be to produce. So when I'm talking about the net to gross ratio, I have to mention the cutoff values. What are the cutoff values? As an example, if I say that the cutoff value of porosity is 5%, and if I assume that the water saturation cutoff value is 70%, and the shale volume or the volume of the clay is 80% cutoff, that means that any interval of porosity less than 5 and water saturation more than 70, and the shale volume is more than 80%, so I will not going to consider it is a net pay. Other than that, it will be a net pay. So this is how I can configure the net pay. This is an example. If I have this interval from the log, and I can put these zones in the my calculation, and took an average. This is how we can calculate it, an average in each zone, and we will have the average of all zones. So I can get the minimum and the maximum porosity at that zone, and the average porosity, I can use it in the volumetric calculation. And depend on that, I can put the net pay thickness. And finally, the formation volume factor. We must all know that what is the formation volume factor? It is the volume of hydrocarbon in the reservoir divided by the volume of the hydrocarbon at the surface. So when we're dealing with oil in the reservoir, the volume will be more than the surface because of dissolved gas. So you will find the formation volume factor is more than 1. But in the gas reservoir, the gas in the reservoir will be less than the volume of the reservoir at the surface. That's why, because of the compressibility. So the formation volume factor, or the beta G, will be less than 1, maybe 0.8 or 0.1, because of the compressibility. This is the formation volume factor. What I'm concerning about is the reserves at the surface, at the condition of the separator that I have in the field. Finally, in the volumetric method, I have deterministic and probabilistic, and the difference between them. When we say deterministic method, we are dealing with, I know my reservoir, but I have uncertainties like the oil-water contact or the gas-oil contact, or I can have uncertainty in the petrophysical analysis or the water saturation. And in sometimes, and this is the analogy method, that I don't have enough data, so I have to work with analogy. When I say analogy is a method to estimate the hydrocarbon in place or the reserves, we use it with the volumetrics. So we make it with analogy. What I mean by analogy? I'm looking for the neighbor field and see and took the input data from the field and applied in my calculations. So by analogy, I can get. So many uncertainties I could have. So in that way, I make this deterministic method. So I could have 1P, 2P, and 3P with uncertainty and level of confidence. This is how it works. So as an example here, I have two wells that drilled, the first one in the hydrocarbon and the second one in the water. So where is the oil-water contact? Of course, we have many things to do like XPT and formation pressure testing and something like that. But if I haven't something like that or pressure measurement, I can make an assumption that I have here the low case. So I have this volume, which is pessimistic, and the mid case will be if I have the contact and all of this volume will be hydrocarbon, or a high case that all of this is a hydrocarbon. This as a deterministic method. We determine the how the uncertainty and put the ranges. As an example, in the porosity, we have, we all know that we have something like called arithmetic average and weighted average. And the difference between them, it could be 1% in the calculation. So I can, as an example, I put the arithmetic average as a 2P, a 3P, and the or 1P, and the weighted average is a 3P, and consider this is called deterministic method. For the probabilistic method, here, before I start the probabilistic method, so there is a thing that we have to be stand on the same ground before we are talking about the probabilistic method. And this ground will be, what are the differences between the mean and the median and the mode? It's I know that it's a basic mathematical question, but it must be clear. If, as an example here, if I have 12 months, each month have a number, something to be sold, guitar or something, we have here a number that, as an example, in January, we have to sell 5. In February, we have to sell 8. This example to show you the differences between them. So I will put it in the ascending order. And here, the average, we all the average, the summation subtracted by their numbers. But what about the median? The median is the number if I put the 6 number at the right and the 6 number on the left, because the summation will be 12. So the median will be the median, the mid number between the 6 on the right hand and the 6 on the left hand. And what is the mode? And this is the most concern for me to know. The mode, it is a number of succession of the same number. So here 10 is repeated 3 times. So the mode in that is 10. So the probability to find 10 in the 12 months is the higher one. This is the mode. So here, as an example, before we go to a software like REP that we are using or most popular or popular in the oil and gas industry, we have to mention what is the Monte Carlo. This is the most popular way that we are used in the probabilistic method. Monte Carlo, simple. It is a random approach that if I have something like the volumetric calculation, I have, as mentioned, I have area, gross rock volume, porosity, and formation volume factor. All of these parameters have uncertainties. So I can get a range, like examples, as we said, porosity from 22% to 23%, a range, different ranges, and put it all together. And Monte Carlo will multiply all of that numbers in random way. So what I have to do is to tell him the iteration. It will make a lot of iteration. He will repeat this random multiplication how many times. This is how Monte Carlo is working. It's a random, and it's very effective, by the way. So here is the, as an example, for the porosity and water saturation and the net to gross, I can give him the averages and the mode and high probability that I can get this number. I give him the input or the average and the most higher probability to find in each parameter in the volumetric calculation. And after that, I'm giving the iteration control. I'm telling him that to make this iteration or make this calculation, as I say, as an example, 2,000, 20,000 times to get the final probabilistic results. And then, of course, I have to get the area versus depth. It could be get by from Petrel or something like that, or any other software from the seismic interpretation, and depth map. So you can multiply all of that and will give me what is the maximum and what the mean and the percentage. If you see that, he will give me that as an example, the 10%, P10 is 990. And the P50, which is the cumulative, that the reserves could be this number or more, or less, sorry, 758, or the P90, like here, it will be 627. So this is how probabilistic method done. And after that, we have to mention the chance of success. As we mentioned before, the presence of reservoir and the source presence and the effectiveness and the trap, we can have the chance of success percentage is 15. So it works like that. If I have, as an example, original oil in place 25, the reserves will of the recovery factor 30%, so I have 7.5. So I have to multiply it by the 15%, it will be 125 million. And we call it the unrisked reserves. So the risked reserve will be 7.5, but unrisked reserve that according to it, I can make a final investment decision, it will be 1,000,000.125. Just an example. This is how volumetric calculation happened and how we can use the analogy with uncertainties in that method. The second thing is the material balance. As I mentioned, each item must have a single course or single session to be present, but this is a brief. Before we go to the material balance equation, we have to mention two things. The oil reservoir type. All we know that we all have to know that in oil reservoir, as an example, we are dealing with undersaturated oil reservoir and saturated oil reservoir, and in some references there is another called gas cap reservoir. What is the undersaturated reservoir? If my reservoir is above the saturation pressure. And what is the saturation pressure? It is the pressure that below it I will have liberated gas, above it the gas is dissolved in the oil, so it will find in one phase. Below the saturation pressure, the reservoir will be in two phases. So if I have the reservoir in one phase, as it is undersaturated oil reservoir, as it's above the saturation pressure. If it is saturated oil reservoir, so I will find the saturation pressure in the reservoir. I will measure it. And the gas cap, that it will below the saturation pressure, the reservoir, and I have the gas above the oil. Another thing before we go to the material balance, we have to know that according to during the reservoir depletion, I know that it may be fundamental for many reservoir engineers, but it could be helpful for beginners that are attending. So during the depletion of the reservoir, the pressure decrease, and also the fluid behavior will change with time. So in material balance, we are not dealing directly with the pressure. In the material balance equation, we will not find a parameter with pressure, but we will find all the parameters that can affect it with pressure, a change with pressure. So there is some lab tests that could be done to know what is the saturation pressure and how the behavior of the fluid change with time. Here we have the saturation pressure. This is called the CCE, or constant composition expansion. We know the saturation pressure like here across the before and after the pressure, saturation pressure, and this test called the CCE, that we deplete the reservoir at the same temperature and then open the choke to produce it, and etc. So by this test, we can have in each pressure depletion something called formation volume factor and the RS, or the gas oil ratio, in the reservoir, and of course we will have the gas oil ratio from the wells. So the material balance, it is like that, like I mentioned, the N is the original oil in place, the NP is the produced oil, and we have here the formation volume factor, the current formation volume factor that can easily done by the DV test, or differential vaporization, and also the RS, that dissolved gas, that also can done or get by the DV experiment right here. So we have all the parameters that change with pressure, and logically, if I have two reservoirs one reservoir is depleted by 100 psi and another reservoir depleted by 300 psi at the same interval of time, so the depletion in some reservoir will be less. So it's an indication that it's more volume if we say that both are producing the same rates. So this is how material balance works. The challenge in material balance that I can quantify, have many correlation, of course, but I can quantify it accurately the water influx in the reservoir. So we can use the, if I have another approach as a volumetric with the original oil in place, so I can put it in the material balance and expect the water influx. It's a we call it matching parameter as reservoir engineers. So this is about the material balance. For the decline curve analysis, here as an example with the production decline in the reservoir, that's another approach. We first talk about the volumetric function or the volumetric equation that depend on the geologic setting, and then the material balance, which is depend on the an equation. Here it's an empirical method that the history, we depend on the history to predict the future. It's an empirical method with a very different approach. So using different approaches, we're reducing the uncertainty. Here, if we see the production in the production forecast, we have a natural decline, and this is the cumulative production. So we can make this empirical method to estimate. So someone called Darbs in 1945, after many study, he said that we have three way of decline. We have exponential decline, harmonic decline, and hyperbolic decline. And each decline have an equation. So it can predict in the future, if I have this rate, I can predict in the future something called the estimated ultimate recovery. And here to understand, full understand with this decline curve analysis, I made this Excel sheet. If you see that the Excel sheet, as mentioned, that if I have exponential decline, the Q will be equal Q1 exponential power minus decline rate multiplied by 10. What meaning of that? I make this practical example to fully understand. If I have here a production from a well, as an example, the first month will be 1,000, and I have a decline. So at the last year will be 314 stock tank barrel. I have this decline. So the decline rate, monthly decline rate, will be equal ln this number over this number. So it will be the monthly decline rate. So I will have the negative 10%. So I can say that it's a 2.5. The decline rate here, or the DI, it will be 10.5%. As a DI, that will be put here. So in the exponential, so I can get or make the put it in the logarithmic chart, so I can predict the rate. So if I have here like Q5, I want to expect what is the rate in the Q5. So it will be like here, as you see, the Q1 as here, the initial, I use the initial rate multiply by exponential, the DI, the decline, the monthly decline rate, multiplied by the T, this is the fifth month. So it will be equal 590, which is right here. So the same as the Q11. In the 11th month or the 12th month, I put the QI as here in this rule, and the decline rate is here, and the last the time in the 11th month is here, and it will be 314 like this one. So this is how decline rate. And if I deal with harmonic, if I deal with hyperbolic, sorry. So in the hyperbolic, we have factor called B, and B, it depends on how gently the decline will be. It's like harmonic as B equal 1, or exponential as B will be equal 0. It's about how gentle it will be. So as an example here, I assume that I have a B equal 0.5. So if you see the rule of the hyperbolic, it is equal 1 plus B, the factor that how gentle, as I said, it multiplied by the decline multiplied by the time that I expect, power by 1 over B. And for the harmonic, same as hyperbolic, it will be the B equal 1. So here, if you see it on this equation, This is the decline rate, this is the initial, and this is the time interval. And you will find that the forecast or the expected production at the 11th month or 12th month, it will be 4.1, which is higher than 13.44. It will be higher than that. So this is how decline curve analysis done using the empirical equation, and it's very simple and it's very realistic, and we depend on it. But after we have a decline and production. So before I finalize the decline curve analysis, we have to mention that I must have the decline of the reservoir. So no change will happen in the separator pressure, in tubing size, in choke setting. No workover happened in that time interval of the decline. No compression station added or compressors. Operating hours, when I mentioned the production across time, it must be over 24 hours, because I can find maybe there is a production of 12 hours. So obviously I will find the production in that day lower than the normal one. And if I'm dealing with artificial lift as an ESP, I have to deal with a constant frequency and constant parameter in the production. No change happen. I have to get the decline only for the reservoir. Final or the last reserves evaluation method is the reservoir simulation. And reservoir simulation is a very huge title, as we all know. But briefly, the reservoir simulation, with example, we will going to see with each other. As here, I have a structure model that done by geophysicists or stratigraphic model. And from the other side, I have petrophysicists that work in the wells that intervened in that field with the interpretation of the petrophysics. And we combine each all of them in a features and property model. And now we call it a static model. So we have a static model, respect the structure, respect the petrophysical analysis, respect the petrophysical, the features distribution, and rock typing. After that, I will have many cells, each cell representing or half quantity of all of that, the porosity net to gross ratio or something like that. And I need to make a dynamic. What is a dynamic? What is the dynamic model? The dynamic model is a model that make a calculation between cells with all the dynamics that happen. And what are the dynamics? We have a pressure dynamics, we have a saturation dynamics, we have relative permeability or fluid movement dynamics according to the saturation. So after that, we make this dynamic model, and we make a prediction and a history match that we will see that how wells in the model produce, compare it with the real data, and make history match so we can approve the model. As an example here, and before we go to the example, this is how the approach of simulation happened, that the simulation is depend on the mathematical model, numerical methods like finite difference method, implicit formation, and Newton-Raphson method, and the grid system. We will, if you want to know more about simulation, you have the corner point grids that respect the deviation or inclination or ununiform shape, and the Cartesian radial grids. So this is how it works, that each cell will have a static value and a dynamic model. Here is an example for the as a sector model, a static model. Here we can make a structure map, very simple, from the seismic, and make a layering, take this structure and make a layering, depend on the top and the base if I have. And I have here one well with the well petrophysical analysis. And after that, depending on my knowledge and my experience in the field, I can make this distribution as a channels or something. And so I have a distribution with the lithology. And now features distribution, it's a model, a static model that respect the lithology. And after that, in each lithology, as sandstone, siltstone, or anything, or carbonate, I can give a property like porosity and saturation and net to gross ratio. So I will have something called the property model. Until now, I'm making the static model. For the dynamic model, I'm giving the input data. The input data will be first, I have to put input in the model, the pressure at a certain datum, and the saturation above the free water level and below the water level, and give him the capillary pressure and the relative permeability, so the model can distribute, and this something called model initialization, can distribute the initial condition, the saturation, and then make an input with the PVT or the fluid behavior changes with pressure, as you see that, as you saw in the CCE and the DV lab test, across each pressure, the formation volume factor, and the dissolved gases. And then after I doing my math and the software doing the calculation depending on the partial differential equation and all of that, I can make like that the history match and make a prediction. So I have an initial oil in place and I can predict the reserves according to the input data that I have made. So now I finished how reserves evaluation and could be estimated. And the final thing, briefly, we can talk about the field development planning in the last 3 slides. In the field development planning, according to the PRMS, if I have a reservoir, if I have a property or a license or a lease area, and if I have a project, they all connected through the net recoverable resource. So it's called a project-based classification system. We have a project. So in field development planning, all I have to do is to make, and I have discovery status uncertainty and commercial status uncertainty. The discovery status uncertainty, okay, I have the reserves evaluated as 1P and 2P and 3P, deterministic or probabilistic. So I have, as a reservoir, make the forecast. And then I have to see, to calculate the commercial status, that the market price, the uncertainty of the oil prices in the future, the operating cost and the capital cost that will be spent. And after that, I will have something called net present value. And when I'm talking about net value, we are talking about the cost subtracted by the the net value, the revenue subtracted by the cost, whether it's operating or capital. When we say the present value, here's the thing, that in the petroleum economics, there is something called, or any economics, is something called the present value. We all know that the value of the money is now is different from the value of the money in the future. As an example, if I have inflation or I have discount rate like 10%, so the next year the value of the money will be less than this year or that time with 10%. So here an example that can show us the net present value rule. The net present value rules say that it will be equal to the net cash flow, the cash that I have at certain time, divided by 1 plus the discount rate over the T. That, if we see this example, if we have a cost like $40,000 right now, and to make a project that will gain a cash flow like $13,000 per year. This is the cash flow, but this is not the present value. To calculate the present value, see, we will find, according to this equation, we will find in the first year it will be 11. In the second year, the value, the present value will be 10. So in this pretty example, if I make a project with $40,000 and the cash flow in 5 years will be 13 multiplied by 5, because the cash flow is 13 per year. So the total will be $65. So it's very misleading to say that, yes, okay, I will, my profit is $15,000. No, because I'm dealing with inflation and discount rate. It's like 10% decrease in the value. So if I make this net present value and summation the value of this money in the 5 years with the value of the money right now, it will be like 41. So it's almost break even of this project. This is how the net present value is the net present value and field development planning happen. So as I can make according to the PRMS, according to SEC, I can evaluate the reserves 1P, 2P, and 3P, and take the final investment decision according also to the cost and how the production forecast will gain in the upcoming 10 years and the net present value. So I can decide the OPEX and the CAPEX and decide how the production forecast will help me to get to be a profitable project. So now I'm very happy to present this webinar and open to any question if you have any. And I'm sorry because I think that the presentation took more than 1 hour. Any questions?
There we have a question in the chat section. I don't know if you can answer, please.
Okay. In the chat?
Yes.
The WMS is open source. Okay, it's about the volumetric, and I mean, no, I think it's not open source. It's software called REP. It's very simple, but no, it's licensed and it's not an open source. It's called this software. I will REP. It's called REP. And I have another I just want to today. Okay, thank you. Any other question? Is Petrel only? No. There is for the question. There is a lot of software. The most popular, of course, is Petrel, but there is another software. I don't want to make. I think we have now T-Navigator and all of these softwares dealing with the simulation and all of that. But and there is CMG and a lot of software. I use Petrel only. Okay, the decision of exploration. Okay, I'm waiting. Okay, to answer this question, I have to come back to this slide. Here, for the exploration phase, we only have volumetric method. So it's about the level of confidence. So if I have, according to the maturity of the prospect, if I have, as mentioned, the project maturity, in the project maturity slide here, if I have a prospect, so I can, I have the anomaly and I have the, I already I don't have answer, yani, the uncertainty is low in the play and the source rock and the chance of success. I calculate the chance of success. Based on that, as I said, that we have unrisked reserves, so I can make this decision in the case of exploratory well. So it's only volumetric, of course, in the exploratory phase. All I have to do is to make chance of success depend on the present and the effectiveness of the play parameters that I calculated. For the development wells or development project, we can use, I think, okay, the reserves as mentioned, that I have material balance, I have decline curve analysis, I have, the more I have approaches with different approaches, the more the uncertainty is low. And also in development wells, So if you are in early phase, so you will deal with the material balance and volumetric. In the late phase, that already produce 30%, so you have decline curve analysis, you can depend on it, so the uncertainty will decrease. So the final investment decision in the exploration phase could be after the chance of success and after the volumetric calculation and chance of success. For the development wells will be with uncertainties or and these uncertainties depend on the how many approaches used. So any other questions?
Okay, if there is no more questions or comments, I would like to thank everybody for attending today in the webinar. It was a pleasure having you with us. Special thanks to the engineer Labib. Thank you so much for sharing your expertise and for this wonderful webinar.
Okay.
For everybody who couldn't join us today, the recording will be available soon and we'll be sharing the link shortly. We truly appreciate your participation and look forward to seeing you in future sessions. Thank you and have a good day.
Thank you.